welcome to ET Now Startup Central, India's first and only daily show dedicated to startups, technology and entrepreneurship. I'm Chandra Shrikant coming to you from India's startup capital, Bengaluru. And today we have a special show lined up for you where we are going to analyze funding data as far as venture capital and angel funding is concerned. Now, in a move that might cause some concern, based on data we've analyzed, VC funding has dropped to a nearly 5-month low. More importantly, angel funding, which was very active last year, has dropped to an almost 13-month low. Why is this happening in the current environment despite VCs sitting on so much of money and despite people expecting 2017 to be a much better year? To really answer all those questions for us, we're joined by a special panel. We have TC Meenakshi Sundaram, the founder and managing director of IDG Ventures. We also have Sanjay Mehta, an angel investor from Mumbai. And we have Arun Natarajan, the man with all the numbers, joining us from Chennai. Arun, before I take it to TCM and Sanjay, I want to start with you. Give us a sense of, why this is happening, the broad trends that you see as far as VC and the angel numbers are concerned.
Sure. The month of February 2017, we tracked about 32, venture capital investments. And, this is, like you mentioned, a 5-month low and the third continuous month in terms of slide, in terms of the number of deals. So what we are seeing in terms of the value, we seem to be okay and comparable to the same time last year as well as the previous month. But the consistent fall in the volume or the number of deals, seems to be something that is very low compared to even what we saw in the October, December of 2016, where we saw an average of at least 50 venture capital investments going through. And this is also across the board in terms of the round of investments, except for the Series B round where there's a minor uptick. Every other round, whether it is the seed or the Series A or the later Series C and D, all of them have consistently fallen over the last 3 months. And like you also said, the angel is the worst affected. It seems to be something like 53 transactions that we saw in June is now down to 21 in February, a consistent fall each month on month. So that's really something that seems to be concerning the ecosystem.
Right. Thanks for that, Arun. TCM, I want to take it to you. He's given a broad sense of the numbers, but give us a sense of the environment, the current environment, why we, seeing this dip. Because there was a sense that, with so much of correction happening last year, 2017 will perhaps be a better year as far as startups are concerned.
Yeah, from where we are, we actually do not see any slowdown in investment from a venture side. In 2016 was possibly the largest commitment and deployment made by IDG Ventures funds. And even if you see the same venture intelligence data for 2016, VC investments were about $1 billion. In our view, the $1 billion per annum approximately is something that's been happening for last 5 years, except that 14 and 15 went up a little bit. 15 went all the way to 1.6 to $2 billion, depending on which deals get counted in. And that in our mind was an aberration where multiple rounds were taking place for the same company within the year and at crazy valuations and lots of money that went in. I think 2016 was back to sanity, where it was back to $1 billion, and we do not see any serious slowdown in venture capital transactions, whether in A or in seed stage funds investments. What we see is that Series B and C and later rounds are still having a little bit of stress, and that is due to two factors. One is in terms of the number of investors who actually can lead Series B and C is limited, And second is, considering the high valuations in which the previous rounds got invested in 14 and 15, the new rounds will face a challenge in terms of, whether the post money of those valuations can be met.
Right.
So that is the stress that
so
you will see in B and C rounds, but not in A.
So I have a follow-up question for you. You said there's more stress in B and C, but even if you look at Series A, it's been steadily coming down. The crunch there continues. So, how are you saying that it's only affecting the later stage rounds and not the early ones?
I think we possibly do not react to monthly numbers, because generally at a quarterly level they will catch up, because we in the market are aware of the number of transactions which are taking place, not only by IDG funds but also by other funds. And as you know, there are many other new funds which are also started investing in the last 12 months time. We believe that there is no slowdown in early stage, which is seed and A, and that I think will catch up when the reporting comes. There is a lag between the transaction underway to transaction closure and reporting, and that may be one of the reasons.
Right. Sanjay Mehta, I want to bring you in because, it's not just VC touching a 5-month low. What's more worrying is angel funding touching a 13th-month low. Because last year we saw so many angel investors becoming active, suddenly family offices becoming so active, but there's been a huge moderation this time around. Again, what explains this? And, are the reasons similar to what TCM is saying, that there are transactions happening, perhaps there's a lag effect, and that we shouldn't go by monthly data?
So my take on this space is there was a froth. A lot of new angels got into the ecosystem, which was very good, but they didn't have much background or understanding on how angel investment works across. So they were more like tourists in the angel space. And once they saw across saying that, okay, few failures are happening, funding crunches are happening, they just shut shop and moved out, saying that I don't want no longer to be funding across startups. They found it risky. See, startups is a long-term game. You need a portfolio approach. You need to be understanding how to evaluate, startups, basic understanding of technology, because most of the startups today are either technology or technology enabled. So many of the, so-called traditional businesses from real estate, diamond merchants, everybody jumped onto this whole angel investing, thinking across this is like a quick buck and, quick money story.
Right. Sanjay, you're almost making some of these angels sound like some fly-by-night operators who disappeared at the first sign of stress. But, the very same factor was being hailed last year, saying that, it's a sign of domestic capital, domestic funding picking up in a big way, which is how ecosystems are built. So, tell us why you think this was a bad thing.
It's not a bad thing. What I said across, it was good. If they would have sustained and learned the art of investing, things would have been very different. So most of them were, thinking across, saying that it was glamorous. First thing what media made, especially TV and, newspapers, they made startups so much glamorous that most of they started having a tag of saying that maybe angel, right? So idea is, how do you ensure that you have a sustained portfolio approach with a long-term investments and with an idea to build a startup. See, startup is not something where you got past data or historic records which you can analyze. So what you are betting is on the team. And if you are unable to work with the team, help them go to the next round of funding, build the value out of that whole idea, then it's just going to be you are giving a dumb money. So that's where all the challenges happened with the first time angels.
Right. Why am I not surprised? Media being blamed again for this, and TV media in particular. But Arun, I'm going to take it to you because TCM says that, this is monthly data. We shouldn't be too worried about it. Perhaps we will see this rationalizing at some point. What do you make of that argument?
No, it's quite clear in terms of, what we have seen in terms of the layoffs and shutdowns that's happening in the bigger, well-funded companies, Snapdeal very publicly. So there is no, doubt that some of that is going to have a trickle-down effect on the B2C. Where TCM is clearly talking about is, sectors that IDG is seeing those, deal flow from. I think they've mentioned before they are seeing quite a bit of deal flow from the enterprise software or even the specifically the SaaS sectors, where none of these really are having any effect. So it really depends, investor to investor, their flavor and the sectors in which they get their deal flow from. So IDG is obviously well known for being product focused as well. So TCM could answer better in terms of the sectors.
Right. TCM, I want to again, take it back to you because funds such as yours, such as Axel, such as Sequoia, they've raised fresh funds in the last 1 year. When we began the year, people spoke about how much dry powder, so-called dry powder there is. So what's really holding back you and these other funds from putting that money in the market? Is there still a sense of caution? Because we are seeing, a lot of corrections happening. I mean, Stazilla shut down last week. Snapdeal announced layoffs. So is there still a lot of caution? Are people really waiting for more correction to happen?
Yes, there is caution. So like you said, I think there is a lot of dry powder. In fact, 17 is possibly the year in which almost all VCs who have been in existence for the last 10 years have raised monies in the last 2 years' time. So I think that is pretty much there is a lot of dry powder. Number two, the B and C stress is about number of people, and also it's a little bit overhang about what's happening to the big boys, right? In terms of whether it is horizontal e-commerce where there is intense competition, or in the taxi space where there is a question of how long this type of competition can a foreign player come and win the market at a later date, is something that is actually keeping the investors to raise the bar significantly. So does that mean is there a slowdown that we expect? We don't. Because the quantity of deals as well as the quality of deals that we see has gone up consistently in the last few years. So we believe that the deployment will take place, but in possibly much more curated, much more higher quality, maybe better traction companies, even at Series A level. I can understand why possibly Angel could be under a little bit of stress, like even Sanjay said. In addition to some people who came and invested a few, and then they are still waiting and watching, or they at will can actually switch asset classes, right? So today stock market is running up, so they can choose to actually deploy money in stock market. So only those who are consistently investing as angels, like Sanjay and a few other groups which are there, they will be every year deploying, just like funds do. Any new party who came in and then looked at it as glamorous, like he said, and maybe like being part of a club, then such aberrations take place. That could have been last year, but this year people will want to. The other reason is also that now most of the VC funds are also doing seed stage deals, so which could sometimes get into the angels stage. So to that extent, you will find a few transactions where seed deals take place with fund as well as angel investors putting money, and in a few cases funds do that. So to some extent it is difficult to separate these two and look at it now, because almost all of us funds do seed stage deals as well.
Right. Sanjay, looks like VC funds are eating into your pie as well. Do you want to comment on that, and also what Arun said about the data?
Yeah, so I have a viewpoint on what first Arun said. Large companies, funded companies like IBM, Apple, everybody had to downsize. These are business cycles. It's all about saying that does the promoter have that tenacity to come back and build the business? And what you mentioned about saying that Stay Zilla shutdown, it's not a shutdown. The founders have mentioned it's a reboot what they are working on. So we should be taking things much saner way. Entrepreneurs are working hard to build a future. They are betting everything as a career on building something which was not existent few years back. And this is the space where many things will fail. You can be on the side and keep on commenting and be right because many things will fail. But if you are going to be part of this whole ecosystem and would like to see an upside and make money, you have to invest and stay put into this whole growth story. Coming back to TCM, yes, it's a wrong cycle or wrong precedent which has started. Many of the funds, like for example, Kalari has got K-Start, or IDG does seed stage, or even Sequoia. Many of the times what happens is this VC funds coming early into startups, if they don't fund the next round of those startups where they are funded at seed stage, nobody is going to touch them. In fact, it works detrimental for startups when they get their first money from VCs. Actually, it breaks the cycle and it hurts them more if the existing VC fund does not invest in them. So I think in that sense, it's not a great move by startups and VCs to come in early. See, VCs are buying in a call put option at a very small value, saying that I'll invest 250K, 500K, and I get a right of first refusal to invest in the next rounds. So I think in that sense, they are playing it far smarter, but entrepreneurs typically lose out if they don't get further investments or they don't perform. While in the angel case, they have got a longevity and they can go to multiple VC funds once they are funded with angel networks.
Right. TCM, you want to comment on this? He says, VC funds getting into angel stage is obviously detrimental for startups if they fail to raise the next round from the same VC. Do you see this trend sustaining? I mean, last year it became fashionable, all round to launch accelerators, accelerators to mentor startups, something that VC started doing, MNC started doing. But when is this really going to stop? Or, is this the new normal? And it's something that entrepreneurs also have to perhaps resign themselves to.
Actually, the perspective of what a seed round is varies from fund to fund, and even the quantum varies from fund to fund. There are a few funds which say my seed stage commitment, like Sanjay said, is only 250 or 500K, which possibly people are looking at it as a call put option. There are a few of us who look at it as seed stage being up to $1 million. And a few, it's even $1.5–2 million. It's also relative to the size of the funds from which the investments are made. But having said that, I think fund investors are being a lot more cautious of the risk that Sanjay spoke about. That if they do not put money into the next round, then there is a risk of the company not getting funded ever. And more importantly, it is also a question of responsibility that we feel. But at the same time, if we find a great opportunity, we do look at investing at a seed stage to be able to grow them rapidly. And there are a few such rounds where angels have been part of. So we don't exclude angels in it, at least from an IDG's perspective, but it varies from fund to fund.
Right. Sanjay,
and in terms of the incubator and accelerator, these are good.
So TCM, idea is, let's say for example, IDG Ventures is going to put $1 million into a seed stage company. You guys as a GP are not going to give time. You will put in some analyst, some rookie to manage it. End of the day, those companies are again being on their own as an entrepreneur. Whereas if angels come in, we actually help build those companies to a level with all the, mentoring and FaceTime. Typically, GPs would give their FaceTime to their largest and most happening active portfolio, not the seed stage. It's more like you are buying, okay, this is a great idea. Let me just buy in and chip in with a small money and lock that company for the next round. If it goes good, might as well, or, then they are left on their own.
TCM, are you assigning rookies to the seed stage and the smaller stage funded companies?
I do not agree with that. Again, I can talk only with respect to IDG Ventures, and in our case, in every transaction there is director, partner level guy who gets involved. So to that extent, for us, if we invest in a company, whether we invest $1 million or whether we invest $5 million, all are same. We have to get each of them to be successful, because you never know which one is going to make it big and which one will not. There are a lot more uncertainties that exist in each of the companies, their business models and adoption. So we don't pick and choose by ourselves, and we give FaceTime, mindshare to all deals.
Right. Arun, I'm sure you must be glad that you're not investing, but only analyzing the data, because there's already an argument that started here. But what do you make? Your closing thoughts as we come to the end of this discussion.
Absolutely. This is really very interesting in terms of where the lines are a bit blurry in terms of what is a seed stage. Clearly, if I can have the time with TCM on the later stage where he mentioned the C or D, we are seeing the existing investors, just the recent deals, whether it's Urban Ladder or Car Trade. These are all inside rounds. So are we lacking and missing the tigers of the world who will come in at these later stage, or do you see anybody else coming in to do those later stage deals anytime soon?
Right. TCM, quick response to that. Are we missing the likes of a Tiger or a SoftBank in the later stage rounds?
Yeah, to an extent, the large investors who used to be very active are not, Tiger being one of them. But having said that, nature abhors vacuum. A good quality deal still gets done, and I am aware of transactions where other investors have stepped up and then put in money. In some situations where there is a gap between the new investors coming in and otherwise, and before that the internal investors are putting together a round. So that's also the that demonstrates the conviction they have in the deals in which internal rounds have taken place. It is done by the internal investors, whoever is concerned, and I don't think they are doing, every fund is doing internal rounds in every company. So to that extent, they are also selecting which companies in which to do internal rounds in, and I'm sure they have applied their minds to do that.
TCM, I think Sanjay Mehta also wants to come in with his closing thoughts. Sanjay,
Yeah, so what I see across, while a lot of this future rounds are being done across, which was expected by those tigers of the world, it's better that those are not existing, because they created that bubble and left many of the companies in lurch by abruptly stopping the investment. In fact, the good part which is happening across in current, which I'm seeing across within my portfolio, which is now almost 60 plus, where a lot of corporates have started investing into startups, and many of the family offices are doing Series A and B deals. And in fact, large amount of focus is now happening across by family offices and corporates. That's a great beginning, which is now an alternate source of capital besides venture funds.
Sure. Right. Arun, TCM and Sanjay, I'm sure we can go on this, but thank you so much, all of you, for that sharp perspective on the current environment. There's a little bit of optimism, some caution, but I think there's also relief that this is perhaps some sort of self-correction that's happening as far as the market is concerned. Perhaps in the coming months, data will start looking more positive. But with that, we come to the end of this edition of ED Now Startup Central. Thanks so much for watching.
Find us on Facebook at facebook.com/etnow and don't forget to click the like button. You can also follow us on Twitter at etnowlive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/etnow.